Good morning, everyone. Kayla Lowry here with the Oregon Association of Realtors. I'm here today with Dirk Conradi, and Dirk is from the Double Conradi LLC. And we had Dirk on a while back to do a webinar. Gosh, it was last year sometime. And it was a great webinar. So we've asked Dirk to come back, and this one he'll be talking about investing in real estate for realtors. So for everyone out there, how and why you can invest in real estate as a realtor. Dirk was born and raised in South Africa and graduated with a double major in accounting and law from the University of Stellenbosch. After practicing law for a year, he moved to Portland in 2001 and started a career in taxes. He studied at Portland State University and Golden State University prior to qualifying as a certified public accountant in the U.S. He spent the first 5 years of his career with PricewaterhouseCoopers LLP and joined Double Conradi LLC in 2008. Dirk is a founding member of Wealth Advisors Northwest. If you have any questions for Dirk that come up throughout the webinar, feel free to submit them via your chat or question panel, and we will answer them as they come up. Again, this webinar is being recorded, so if you know anyone who would benefit from this information, it'll be up in about a week on our online catalog. Here's Dirk.
Good morning, everyone. So today we're going to be focusing about something that you guys all know about, which is real estate. And so an interesting topic to teach people that specialize in real estate. We're going to talk a little bit about investing, borrowing, and taxes. This presentation is geared to any investor, but it does have real estate professionals specifically in mind. And so we're going to talk about some of the things that we do, some of the things we don't do, and just some of the whys. We do have an evaluation form. This is a paper form of it. Kayla will be sending out some sort of an electronic version of this. This is kind of how I get paid. So if you guys could please fill this out. Of particular interest to me, towards the bottom of this particular one, it just says what topics are we looking to learn more about in the future, and then Kayla and I will work together to make sure that that we present some of those at a future webinar. All right. Let's see if we can get to the next slide there. Okay. So this next slide is a slide of our website of my company, and I just want you guys to look at the keyword here, proactive planning, and that's really what we're going to try to do with real estate as well. We're hoping that we can find a way to be a little bit more proactive in this space and actually make things happen. So a little bit about me. I'm a CPA. I'm also an RIA and a PFS, but most importantly, I'm a real estate investor. I started investing in real estate in 2004, went through the 2008 slump, and I'm still investing in real estate today. So it's been a long career in the real estate space. And then I also specialize in financial planning as well as taxes, and so we can kind of see the place that real estate holds within your investment portfolio, as well as how it shapes your future. And that makes it a little bit easier for us to put in perspective why we should consider real estate. So let's start there. So real estate is one of those things that everybody on this podcast, I presume, are practicing every day. And so why would we pick this as an investment as well? We already make our money by selling and buying it for other people. And so why would we invest it in ourselves? And also, how could we help our clients understand why investing in real estate is a good idea? You know, there's a lot of things that we make as assumptions when it comes to real estate. The biggest one that I find with my real estate professional clients is we just get it. You know, we understand how it works, how it's supposed to work. We know if we buy this piece of property, here's what it can do. In the back of our minds, we think that it's smart. It's just smart to purchase the real estate. And we have this nagging feeling as we're helping clients get into real estate that we're missing out, you know, and we don't really know always how to change that mindset from that feeling into action of actually buying it. We also have this idea that there's some sort of a tax benefit into owning real estate, but we're not always specific about what it is. So this is the first property I bought. It was kind of crazy. I didn't have any money at the time, and I bought this property. It's an 8-plex, and I bought it on an owner contract. I still have it, and it's probably my best property that I own. If I had planned to buy the property, I would have looked for all the things that's in this particular property, but I got lucky. I got lucky and bought the right one. What this property has done for me is taught me the things to look for in my investments afterwards. And we'll go through a lot of those today and just trying to help you guys see what to look for if it's your first or your subsequent investment. So let's talk about some of the financial benefits. So we're looking at taxation, depreciation. We're looking at leverage and cash flow. Diversification, in other words, some other form of an asset that we can utilize. We're thinking about things like 1031 exchanges, and we're thinking about a step up in basis and what that means. So I'm going to be exploring each of these topics over the next number of slides in some detail. Please feel free to send your questions in, and we'll be able to answer those questions for you. So let's start with taxes. So the first thing that we need to know about real estate is there's a difference between your tax scenario and your actual income or loss. So when we think about profit or bottom line in real estate, we're going to be thinking about can we make money out of this, and then what's the tax consequences. The concept of depreciation is very important to understand in this context. Depreciation is a deduction the tax code allows us that is not real. In other words, we buy a building, and let's say we spend $1 million on the building, and we're allowed to write off the value of that building over time, even though in reality the building's value is going up. In other words, you bought the property for $1 million. In the future, you can sell it for $1.5 million, but the tax code allows us to take this deduction. This deduction allows you to create a tax loss while experiencing a profit in reality. And that gives you an advantage that's not dissimilar from contributing to a retirement plan. Now, this is especially useful for real estate professionals. When you are a real estate professional, which is defined as spending substantially all of your time on real estate, and it has to be more than 750 hours per year on real estate, you're allowed to take losses from real estate as a deduction against your other income. This is somewhat unique. Your ordinary W-2 clients can't do this. They don't get to deduct those losses. And this is something that actually makes the purchase of real estate more affordable, and also makes it a good reason why, as a real estate professional, you should be thinking about getting into real estate. Now, I do want to be careful here in saying that it's important to distinguish between actual losses and tax losses. An actual loss is a negative experience for anyone, and the fact that you can deduct it from your taxes just makes it a little bit easier to bear. And a depreciation loss, which is not an actual loss, is just a bonus. It's kind of the government's way of telling us there is a affordable way for us to buy real estate. And these are things that you should model out as you go into the purchase of a building. A professional such as a CPA or a financial advisor should be able to help you think through how this is gonna play out. And the way that I do it for myself is I create a cash flow projection, and that contains things like how much do I expect to rent it for, and then what payments do I need to make. I need to pay utilities, I need to pay my mortgage, I need to pay perhaps some repairs, and I figure out, am I going to be cash flow positive or cash flow negative? And then a second calculation is done to see what's going to be the tax result. In the tax result, we have to be cognizant of the fact that we don't get to deduct the entire mortgage payment. We only get to deduct the interest part of it. And also then this depreciation that gets added. And you guys should know the formula for getting to that depreciation number as you go into the purchase of a property. That formula, just to give you kind of the highlights, is you have to split a property into the building and into the land. The building part is depreciable and the land part is not. That's the gist of how it works. Okay, so we'll move on to the next slide here. So now we're going to be talking about leverage and cash flow. So just because we know real estate does not mean it's a good investment. And just because we understand how it works doesn't necessarily mean that it's good. So the first thing is for us to make sure that we're not kidding ourselves or pretending things that we haven't investigated. Many of us don't understand the stock market, and we use that as a reason for not starting something like a 401k or a SEP and investing in the markets. And then we understand real estate and we decide that we should invest in real estate. And so I guess what I'm trying to do on this slide is make sure that we go in with open eyes. So the first thing is, if we look back, the returns in the stock market historically have been between 7 and 8%. And that, of course, is an average. Some years we might get 20 and other years we get minus 10. But over time, 7 to 8% is if we look back 30 years or more. In the real estate market, and I'm specifically talking here about the Portland sort of market, returns historically have been an average of around 3 to 4%. So if we just look at that information by itself, it would seem that the stock market is a better investment than real estate. However, this is only true if we're comparing cash to cash. So if we invested 100,000 in the stock market or 100,000 into a house, it would seem like the stock market is going to give us a better return than the house would. What changes everything is leverage. And leverage is basically us borrowing some of the money for the purchase price of the house. So in my example, if the $100,000 is our down payment on a house that's $400,000, and we were able to cash flow that house, our return is going to be based on the $400,000 number, not the $100,000 number. And that gives us a bigger return. And the key here is higher leverage makes higher returns possible. So in other words, the less money we put down on the purchase and the less money we pour into the real estate, the bigger our potential returns are. So what happens if we do that? Well, the less we put down, the higher our risk. And so if you think about it, if you own a house outright, there are just fewer things that can go wrong. You know, if the house is empty, we're going to be losing some cash flow, but we don't have a mortgage payment to make, so we have less risk. If the economy goes bad and we for some reason can't rent the property out, we're going to be looking at an uncomfortable situation, but we're not going to lose our property. On the other hand, let's assume you have multiple properties that you are highly leveraged, and a few of them go empty at the same time. It's very possible in that scenario that you're not going to be able to make the mortgage payments. If you don't make the mortgage payments, it's highly likely that you'll lose the first property. And that tends to cause a domino effect and can make you lose all of them. In my career in taxes as well as financial advising, I have seen many people lose everything in the real estate market, and I've never seen anybody lose everything in the stock market in a diversified portfolio. So we should be aware that with leverage comes risk. Now, of course, risk reward, right? So if we were able to take risk and get a higher reward, that might make sense. We just want to make sure that the rewards are there and worthwhile. On the flip side, if we leverage less, we can improve cash flow. So this is the scenario where we have a property that's paid for, and that property is now bringing in rent, and you and your spouse and your family get to take that money and use it to go to Hawaii or live. So it seems to be a pretty good retirement goal, right? If we have a bunch of real estate that's all paid off, we can take that money every month and use it as our sort of money to live on. And this is particularly great when you've reached that retirement sort of time frame. I would argue that leverage is more useful as you're building your wealth. And once your wealth is built, it becomes much better to have higher cash flow. So to give you an example of that, let's imagine that you're 25, you just inherited $500,000, and you took that $500,000 and you go buy one house. And that house produces $1,000 a month in rent that you get to spend. It might seem like a great idea at the time, but you'd probably be better off investing that money in the stock market. It'd probably produce better. And you're going to need that money for presumably a long life. If you change the facts and invested, during your life, and suddenly you get this windfall when you're older, then we might have more of a need for producing cash flow. It might be more important, especially if you're in that retirement sort of zone. That young lady that inherited the $500,000 could have purchased 5 homes, and by the time she retired, had them all paid for, and thus producing $5,000 a month. And that's really what we're talking about, is making sure that we're cognizant of in which stage we are to determine what percentage of leverage we should be going after. one other way, a final way of presenting the same information. It's a lot less, it makes a lot less sense for a 70-year-old person to do high leverage than it does for a 30-year-old person, depending on what your goals are. All right, moving on to diversification on the next slide. So what are we talking about here? You guys have all heard the saying, don't put all of your eggs in one basket. I hope you've heard it at least. The concept here is, you know, obviously if we imagine that person with all of their food in this one container, they drop it, all the eggs break, and we have nothing. Whereas if we had it split up, something goes wrong with one, we still have the others. That's sort of the general gist of that example. Now, one thing that we should know is people that get really, really wealthy don't diversify necessarily. So if you think about a Bill Gates, for example, when he started out, he didn't put some money into this company, some into that. Everything was in Microsoft. And that strategy worked really, really well. So diversification is a really good tool for us to utilize if our ultimate goal is not to be extremely wealthy. If our goal is to build wealth, diversification is an excellent strategy. Now, you could also argue, and this is something I did in my when I started out, I had zero diversification when I started. Everything went into real estate. And that strategy has worked out for me really, really well. Now, as I approached retirement, or got closer and got more involved with helping people get to retirement, I realized the weakness of having all my eggs in one basket. The reason I realized it is because I had a lot of eggs at that point, right? So if we're starting out and we only have the one egg, diversification doesn't mean a lot. But as we have something to lose, it becomes more important in your life. So what we need to know here is there's different levels of risk depending on what you're investing in. So there's a different risk in the stock market, there's a different risk in the bond market, and there's a different risk in real estate. And when we put all of these together, our overall package could produce better because of managing the risk better. So real estate is an excellent hedge against a down stock market or against a down bond market. It's also, if run correctly, can produce results similar to an annuity, especially once that property is paid for. It can create a somewhat guaranteed return on your money. And I say somewhat because the obvious things are we have to keep the property rented, and obviously we have to deal with things that come up along the way, such as a roof that needs replacing or those kinds of things. We also have in our back pocket always the option of selling that property and taking that cash and investing it and living off it. Now, I would argue diversification is extremely important as we approach having something to lose. And for most of us, that tends to be the case, somewhere in your 40s. And for some of us, it's earlier. And so very, very person specific. One of the things we do when we meet with clients is we go after what are your goals and what is it that you're trying to achieve. And once we know what you're trying to achieve, we get to advise you on how much you should diversify or not. And so it's something that we need to do in a planning meeting. Let's talk a little bit about 1031 exchanges. So you guys have probably seen your clients do these, and you probably know that there's a tax reason for for doing a 1031 exchange. Now, if we have a stock account, we don't get to do 1031 exchanges of our stocks. We have to pay the taxes when we sell the stocks on the capital gains. Now, this, of course, is only true if your investments are held in a non-retirement account. So if you have it in your IRA or your 401k at work, you can make changes in a tax-free way, at least initially. 1031 exchanges work pretty similar to that. It's a tax-free way of exchanging an investment. Tax-free is probably the wrong word. It's basically saying we're going to delay taxes. We're going to pay it later. Now, one of the big advantages of a 1031 exchange is it helps us re-leverage a property. So let's imagine that you bought a little house for $250,000, and over time you've been paying it off, and now let's just pretend like you have no mortgage on it. Well, at that point, you don't have leverage anymore, and so you're getting a relatively low return on it. We can do an exchange of that property into a bigger property, get a loan on the new property, and we can do that in a very tax efficient way. 1031 exchanges are tricky. You have to exchange a business property into a business property. And there are a number of rules that are non-negotiable that you can't, if you make a mistake, it doesn't work. So if you're going to do this, you definitely want to talk to your tax professional, and you definitely want to talk to a 1031 exchange specialist. One thing that people like to do, or like to talk about at least, is this idea of I'm going to do a 1031 exchange of my rental property into my dream house or my dream beach house or the cabin in the woods. And I like that idea too. Mm-hmm. If I can do that tax-free, that sounds like a great deal. I would encourage you to make sure that you stay within the letter of the law if that's something you're trying to do. Particularly making sure that you don't convert a business property into a personal property too soon. If you do that, the taxes will become due, and like I said, once you've broken one of these rules, you can't fix it. So make sure you work with a professional and that you have a game plan that allows you to do these exchanges successfully. Now, as a real estate agent, you have a real advantage in that you can somewhat minimize the cost of making these changes. You guys are able to waive your own commission. Sometimes you can even find your own property and avoid those some of those costs. You're also coming across deals, and so you're in a very unique position to make an exchange like this very profitable for yourselves. So that's one of the things, once we have the property, that we're going to keep in our back pocket. So let's talk about step up in basis. So this one has to do or works with when someone dies. So if you buy a property and over time the property becomes more valuable, you're basically creating a capital gain problem. The capital gain problem says that if I sold this property, I'm going to have to pay a bunch of taxes. Very few of us would volunteer to pay those taxes. If we had a different choice, we don't want to pay it. The tax code provides one such a choice, and that is if you kept the property for your lifetime, and after you died, you left this property to your child, for example, the child inherits the property at its fair market value. That means that the child would have no tax consequence if they sold the property right away. And it is effectively one of the few ways out there that we really get to avoid taxes. Now, of course, I would argue it's one of the least desirable outcomes, right? Because you have to die in order to get this benefit. But it does make, when we look at the overall game plan for owning real estate, it does make a pretty good planning consideration, which is if we can avoid selling these properties, especially late in life, we can avoid at least the income tax portion of it. And this is something that we plan for as we start planning your retirement, how that's supposed to work. The one thing that people don't know about is in a community state property, the step up in basis happens even if a husband and wife team owns a property. It happens for the surviving spouse. Now, community property would be Washington, and so for us Oregonians, it doesn't apply. But if you're in California or you're in Washington at some point in your life, know that these rules apply to you if your spouse passed away. For us in Oregon, our spouse owns, technically speaking, owns half of the property. So the step up in basis only applies to half of the property. So let me give you an example. Let's say we have a property that has a value of that $250,000, and we bought the property for $200,000. I'm using simple as possible here. So we have a gain of $50,000 in that property. If we sold the property, we would have to pay taxes on the $50,000 gain. If both spouses passed away and left it to their kid, the kid would have no tax because the kid's the capital gain would go away. That's what a step up in basis does. If one spouse passed away and left it to the other spouse, the capital gain would be halved. It would be 50%. In other words, in this example, $25,000 would be a capital gain for the surviving spouse if he or she sold that property. What's the takeaway here? Just remember that if someone dies, some change has to happen and you need to talk to your tax professional. I mean, that's really the important takeaway. There is something that needs to happen. So let's talk about the kind of real estate. So assuming we've decided we're going to invest in real estate, well, there's a lot of different possibilities. There are commercial properties. Those are your business properties where you have a lease to for example, a Walgreens or something like that. And then any multifamily residential that has more than 4 units. So a 5-unit and up property is commercial. Then we have bare land. And then we have residential, where we're talking about single family homes and any multifamily property that has up to 4 units. So which one should we pick? Well, let's just talk about some of the advantages and disadvantages. In a commercial property, if you have the right one, and we're talking specifically about business properties here, you can have something that's called, or you can have a situation where you can have a really long-term tenant. And typically in these commercial leases, the tenant pays almost everything. You're responsible for the outside of a building, but the tenants are responsible for pretty much everything else. If you imagine in our scenario that Walgreens, once the Walgreens moves in, if it's in the right location, you know, they might stay there for your entire life. And you have this built-in tenant and everything is going great. The downside is if that tenant moves out, it's really difficult to find a new one. You know, it was designed for a Walgreens specifically, so very difficult to go put a restaurant or a doggy daycare or some other sort of business in there. And there's costs involved in doing that. So anytime you have one of these commercial properties, you need to have a substantial reserve so that you can go through lean periods where you have no income. Now, of course, that's not true if you strike it lucky and you get the right location. And lucky might be the wrong word, because we might be doing some planning and some thinking about it. But we should always bear in mind that there's a chance that this property sits empty. There's a building that I drive by a lot. I've been watching it for about 15 years. They did this great development, and it had about 7 or 8 storefronts, and it has never ever been rented. And I always look at that as a reminder of what can go wrong. On the other hand, most of us drive by businesses that have been around for years, and if you had one of those buildings, you would be able to, you would be much happier.
So Dirk, we have a couple of questions. Going back to, I think when you were talking previously about the step-up basis.
Yes.
How would this work? And I assume they're talking about the example you provided. How would this work with inheritance taxes? And what if the property in your example is in a trust?
All right, those are excellent questions. So the first thing, when we talk about taxes, there are 2 kinds. The one is the income tax, and the other one is an estate tax, and that's the so-called inheritance tax. In Oregon, the first $1 million of inheritance is tax-free. So if your estate is under $1 million, you don't have to pay any taxes. That $1 million is given to each spouse. So you're both able to take that $1 million into account. Anything over $1 million in fair market value in Oregon, you have to pay taxes on, and the tax rate kind of varies. It averages out to about 16% once you get to enough money. It's on a sliding scale, so it starts on the first dollar after $1 million. So attorneys can help you figure out how to make sure that between spouses, you're taking care of it. Now, for the federal law, that number is now, more than $11 million. And so for most of us, it doesn't really apply at a federal level at the moment. Of course, a next administration or a next federal government might change that, and we need to keep our eyes on it. But at the moment, if you have a couple, you have about $22 million of exclusion federally. Oregon doesn't follow a gift tax, and so it's possible to gift some of your estate prior to passing away, and then it doesn't impact that $1 million. There are some hoops to jump through and some things that you have to do, but it's possible to do that. So the step up in basis does not help us when it comes to estate tax. It only helps us when it comes to income tax. The second part of the question relates to trusts. If you have your property in a revocable living trust, the step up in basis rules work, and it's the same way that I just described it. If, however, the property is in an irrevocable trust, and this is something that happens, for example, when someone passes away, their revocable trust becomes irrevocable, or at least part of it usually. In that situation, the trust doesn't die, therefore there's no step up in basis. So the question on whether you get the step up or not is on whether the trust is revocable or irrevocable. So to to give you that complicated stuff in a sort of simpler way. If you can change the trust during your lifetime still, you're going to get the step up in basis. If the person who created the trust isn't around, or if you created a trust that you can't change during your lifetime, you're not going to get a step up in basis. And you guys really need to work with your attorney here to make sure that you set it up right and that you take into account both estate taxes as well as income taxes and kind of, create the best path.
Let's take one more question here. You mentioned that realtors can take losses from their real estate portfolio and deduct it from their realtor business. Are there any other benefits that would work directly between realtors in their real estate portfolio besides commission-free buy-sell and writing off losses into their realtor business?
It's a little wider than your realtor business because you're also able to write off losses against your spouse's income if you're married. So if your spouse is working at Intel on a W-2 salary, real estate losses can go against that spouse's income as well. So it's not just your realtor business. That's only true if you're a real estate professional, or one spouse at least is a real estate professional. The obvious advantage is, everybody that's on this presentation works in real estate. So you guys get to see the deals. When it's a good purchase or not, and you tend to see them first. So you tend to see the opportunities to buy before everyone else because you're looking at it consistently. I think that's really the biggest advantage. It's the space that you move in, and then we can do that somewhat tax efficiently, and then we can also obviously save some on the buying and selling costs. So those are the main advantages and the main reasons why it makes sense. On the flip side, the thing that's not so good about it is you're already heavily in real estate in terms of your earnings. And so if you buy more real estate, you're tying yourself to the real estate market more, and that's the opposite of diversification. And so you just want to try to balance those two things, if that makes sense.
Do you want to take one more?
Yeah, why not?
Okay.
Yeah.
So this one's a little, I haven't heard you talk about this yet, so it's a little maybe left field, but I'll still ask it. Can you share thoughts about using an HELOC from a primary residence as a down payment for my first investment property?
Yeah, that's coming up. So
Okay.
so we'll tackle that one here.
Lucy.
Yeah, we'll tackle that one here in a minute. All right, so commercial properties has another downside in that you have to put down more money on them. So where you can buy a residential property for 20% down or sometimes 25% down, with commercial properties, it's usually 30% and more. Sometimes up to half has to be put down. So from a cash flow perspective, sometimes harder to do. With land, the obvious downside is it's highly speculative. We're buying something with the idea that it's going to go up in value, or we're going to be able to develop it, or the urban boundary is going to move, or something like that. So speculative, higher risk, and also it doesn't produce income. So you don't get rent from it, and that makes it a little bit harder to do. You also tend to not get, the loans on land tend to be pretty difficult to get. So you tend to have to put down more cash. And then with residential, these are the easiest to buy, they're the easiest to finance. They're also the ones that most of you are operating and seeing the most. So these are kind of easy to do. But because they're easy to do, you tend to have to pay more for them, because everybody has access to the same loans. And so if you were to buy a 5-plex, you're probably going to get a better price than if you were to buy a 4-plex, for the simple reason it's easier to finance that fourplex than the fiveplex, and so more people can afford it. And so these are all things to consider as you're going into it. So let's talk about that down payment, and that's going to address this HELOC question that we had as a prior question. Well, where does it come from is the obvious question. And, I just threw some examples on this slide. And so you're looking at savings or the home equity line of credit, that HELOC, refinancing a property, a loan from your 401k, or a loan from a parent or a friend. I didn't put an investor on here, but that's another example. And to answer the question on the HELOC specifically, what does it do? Well, when we get a home equity line of credit, we're increasing the leverage on a property. If it's our personal residence, we're basically increasing the leverage on that particular property, and in doing so, we're increasing our risk. And so the more you leverage, the higher your risk. And so when we take that money and we go buy another property, we've put down less money, and that's going to increase our returns on the next property. In theory, higher risk, but in theory, higher returns. It is basically the way I built my real estate portfolio, is by buying one property and then leveraging that property into the next property and so on. So it's a very successful strategy. It's something that works. It's something that's used by most real estate investors out there. The downside is you increase your risk. And so you just need to be aware of that. In my personal example, I leveraged a house that I lived in and took out, I think, $100,000 or so to buy another property. And then the market tumbled, and suddenly my house was underwater. So I literally couldn't sell it because I owed more than what it was worth. Banks were unhappy, I was unhappy, and I was forced to stay in that house for about 4 years longer than what I had hoped when I bought it. So there's definitely some risk coming with it. In my example, I would say it was an inconvenience, and I had some trouble with kids being in the wrong schools and things like that. But it didn't cause a domino effect where I lost everything. And that's your worst case scenario, right? The economy tanks, you don't have the ability to sell real estate, and you can't make the payments because you leveraged your house too much. Something to consider with the down payment is the smaller the down payment, the better your return, in theory, but the higher your risk. And so this is actually one of our biggest dilemmas as a real estate agent, is how do we get the down payment? Because that's what stops us from doing it. And so it's something you need to check with your mortgage broker. What is it that I need to do in order to qualify? How much will I need as a down payment? And then you can start setting that goal of getting it. Moving on to the next slide here, on the financing topic, kind of tied to that previous slide. The first thing that you should know is all interest on a rental property is deductible. So all of the tax law changes that you guys have heard about, from home equity lines of credit or refinancing and all of that, if you use a home equity line of credit to buy real estate that is a rental property, that interest on that loan will be deductible. So you might have heard that home equity line interest is not deductible anymore. That is not true if you use that line of credit to buy a business property. Financing can sometimes stop people from doing it. And my first property, I would never have qualified for a loan, so I got owner financing on it. And so those are things for you guys to just consider, is how am I going to get the money? Like, who's going to be willing to lend me this money? And then the other thing that you guys want to think about is, does it make sense to get a 15-year loan or a 30-year loan? And should I be paying debt off faster? These are all considerations that has to do with cash flow. I would highly recommend that you consider getting a 30-year loan and paying it off faster, because that way you have less risk. You're able to make the payments a little bit easier. But it's a case-by-case decision, just something for you to consider. One of the downsides of having real estate is you have to manage it. So there's work, in other words, and here's some things to think about. You can manage it yourself, which gives you that good tax deduction that we talked about. Once you put it up for professional management, we need to evaluate whether you're putting enough time in to make it qualify as a deduction if you have tax losses. So something to discuss with your tax professional. The second bullet point, how to own it. Should you put it in an LLC? You have to consider repairs and maintenance, bookkeeping, tax returns, rental agreements, evictions, legal. All of those things are just part and parcel of owning real estate. Of course, other investments, if you have a 401k, pretty much none of these things have to be done, except maybe the self versus professional management piece. And so just keep that in mind, that you're actually earning this money. You're not just getting it for free. I personally think you should have a plan for every single property. A lot of us will just buy real estate because we can. And that means that you don't actually have a very good idea of what it's for and what it's supposed to do, which means that you don't know when it's a successful purchase or not. So is it a cash flow buy or a capital appreciation property that we're going to sell? Should I pay down the debt? We talked about that 15 versus 30-year loans. Major maintenance that needs to be planned for, such as a new roof or painting or new siding, and a game plan of, are we going to sell this property, or do we intend to leave it to our kids? What's the plan there? And then this last, somewhat close to the end here on this slide, just be aware that real estate is just one piece of financial freedom. Very few people can get to complete financial freedom and the only asset they own is real estate. We want to consider other things like tax efficiency, the efficiency of retirement plans such as 401ks, SEPs or simple IRAs, Roths are out there. We want to think about liability protection, things like life insurance or umbrella policies, those kinds of things. And estate planning, which helps solve that question of, should I be giving money as gifts, or should we be putting it in a trust, or how do we avoid that dreaded estate tax? So that gives you guys a lot of information. Let's just check and see if we have another question here.
We have two more. When you purchase a property, how do you specify for tax purposes that this is an investment versus a personal property?
I think that one answers itself by how you use it. If you're buying a beach house and you use that beach house for more than 14 days, it becomes a personal property the moment you used it personally more than 14 days. So if you buy a property and it's rented out 100% of the time, it's clearly an investment property. So personal use is what makes that determination. And once you tell your tax professional, I used it more than 14 days, it's a personal property. So that's your behavior defines that.
And then should a new investor hold their income property under the same LLC as their realtor business? Or is it best to have two separate LLCs, one for investment business and one for realtor services?
So a little bit of a legal question there, which I'm probably not the best person to answer. I will say that from a practical and from a tax perspective, it probably doesn't make sense to have it in the same LLC. But it's something that we want to check with our attorney and make sure that that I'm not missing something there. From a tax perspective, you're going to have to keep separate books for the rental property and for the real estate professional business. On the next slide is just my evaluation form again. I'm asking you guys if you could please fill out the form and give me some more information. You'll also notice there is the option of a complimentary consultation. After the meeting we had, or after the presentation last time, I spent some time with a lady from Salem, and we just did a little video conference and answered some questions. So if you have questions specific to yourselves, I do that complimentary, and sometimes we'll work with people after that, and sometimes we won't. So just know that's available, and feel free to take me up on it.
And that'll be being sent out to you via link in an email before the end of the day today. I do have one more question. You want to take it?
Yeah, okay. Go ahead.
In buying a rental with cash, is it better to sell it on contract or simply rent it and sell, say, in 10 years?
Oh, that's a good question. I guess it depends on what you're trying to do. The challenge with selling something on contract has a lot to do with in what condition would you get the property back if something went wrong. And so selling on contract does require you to, I think, at least get a really good down payment, which sometimes defeats the purpose if you have a property that you just purchased for cash. But that's what I would say is your down payment needs to be sufficient to be able to take on the risk of that buyer, starting to cook up meth or something in your house and causing a lot of damage. If you take back a property from an owner like that, it's expensive, so you want to get a good down payment. The advantage of the installment sale is you're going to be spreading capital gains over a longer period, so you're probably going to get a better tax result depending on your other income. The 10-year selling it 10 years later, of course, that's going to depend entirely on what the market does. So you have a little bit more risk because you don't get to lock in the sale price today. So both have merit. And I would think that the answer to the question lies in what is it that you're trying to achieve. If you're trying to achieve a specific return, it might be easier if you lock down some of the variables by selling it on contract. Whereas if you're just hoping to cash flow a property for 10 years and after 10 years make a profit, and it doesn't really matter as much how much you make, then that might be the better strategy and probably will produce a better result in terms of how much you make. So difficult question to answer because it involves some things in the future that we don't have the answers to. Of course, I'd argue that as part of a financial plan, those are the kinds of questions that you can model out and answer as part of a financial plan. All right, I thank you very much for listening today. Hopefully you guys learned something. Like I mentioned, please give us some feedback on what you'd like to hear more for so we can come up with the topic for our next presentation. Hope you guys have a wonderful day.
Thank you.